970% growth in just 5 years? That is the kind of explosive success story that captures the world's attention, and it belongs to a name many of us know, Rolls-Royce. Yet here is the twist. Another firm in the very same aerospace sector, Melrose Industries, has soared just 98% over that same period. Surprised? Intrigued? You should be. Because today we are pulling back the curtain on why this discrepancy exists, what it reveals about the dynamic world of aviation and defense, and how it leads us to examine not one, but two hidden gems in the United Kingdom stock universe. Are you ready to discover how some British stocks are defying the odds, shaking off supply chain nightmares, and positioning themselves to potentially beat the index average in the coming months? Today, we dive deep into the mysteries surrounding the aerospace rebound, the stealthy pivot of a technology company, and why so many investors might be overlooking these golden opportunities. In this episode, our lens zooms in on two major questions. Can Melrose Industries overcome its recent industry hurdles to claim the stellar trajectory it seems destined for? And will Celebrus Technologies, the under-the-radar tech player, finally unleash its profit potential in a time of digital upheaval? Strap in because we are about to break down the storyline behind Melrose and Celebrus, analyzing the yawning gap between public perception and the tantalizing data that points to big leaps in earnings, strong economic moats, and powerful fortress balance sheets. We will look at the persistent supply chain entanglements that have weighed down entire industries, explore the slowly improving global sentiment around travel and defense, and reveal the hidden catalysts that might shift momentum in an instant. Where better to start than with the heart of the narrative, Melrose Industries? On the surface, the data is compelling. Over a 5-year period, Rolls-Royce shares catapulted by 970%. Meanwhile, Melrose modestly climbed by roughly 98%. That alone might raise a few eyebrows, as both companies are part of the same grand aerospace ecosystem. Both are influenced by the uptick in civil aviation, and both stand to benefit from a world that is steadily opening its skies after global lockdowns. So, why is Melrose lagging behind? We have to zoom out and remember that 5 years ago, the entire landscape looked almost unrecognizable. We were in the throes of an unprecedented health crisis, with lockdown measures sending civil aviation plummeting and entire fleets parked on tarmacs. Yet from the rubble of that meltdown, some companies soared higher than ever. Rolls-Royce, famous for its engines that power commercial jets, found itself on a remarkable upward trajectory that, while absolutely extraordinary, is not the entire story of aerospace. Enter Melrose Industries, whose growth was tamped down by a host of factors, from supply chain shortfalls to complicated strategic realignments. But here is something that might make your ears perk up. Melrose's leadership envisions a future that includes over 20% annual earnings growth through the end of the current decade. That is not a wild rumor, but a stated ambition, accompanied by a plan to boost revenue by more than 43% over an approximate 5-year span, culminating in doubled operating margins by roughly 2029. If all that does not come off as aggressively ambitious, perhaps nothing will. Yet, the market is placing a relatively conservative valuation on Melrose, pegging it at about 14.1 times forward earnings. That ratio alone might set many investors pondering. After all, if the company's growth path proves real, that multiple starts to look almost absurdly cheap. There is more. Several industry analysts estimate that Melrose's price-to-earnings to growth ratio sits around 0.7, indicating a potentially undervalued gem compared to the broader aerospace sector. Bear in mind, a PEG ratio below 1 often signals that a company's earnings growth could outperform the typical yardstick. But, as with all rosy pictures, we must also scan for clouds. The biggest watch item looming over Melrose is whether supply chain disruptions will persist, further choking off the ability to deliver robust performance quarter after quarter. You have probably heard it on the news over and over again. Chip shortages, shipping delays, raw material bottlenecks. These are the invisible webs that continue to snare industries far beyond aerospace. And if these tangles linger, that ambition of doubling margins by 2029 might face serious headwinds. Nevertheless, here is the silver lining. Melrose Industries boasts a powerful economic moat by virtue of its unique technology offerings, developed for everything from aircraft engines to automotive components. A staggering 70% of its revenue, by some measures, arises from what analysts call sole source positions, meaning there is little to no direct competition for what they provide. That exclusivity can be pure gold in business terms, letting them command better margins and maintain a competitive edge. Now, let us pivot onto a new stage, away from the roar of jet engines and the smell of kerosene, to the quieter realm of digital transformation and big data. Celebrus Technologies may not be a household name, but if you are on the hunt for small-cap technology that could offer big returns, it is certainly worth a second look. The company's revenue, according to rumors swirling around the industry, has been a tad soft lately, thanks to macroeconomic uncertainty and unpredictable geopolitical events. This softness would normally have investors running for the hills if it were not for one critical detail. The company's earnings are showing remarkable resilience, bolstered by determined cost discipline and strategic moves toward more lucrative software segments. Many tech-curious observers whisper that Celebrus is steadily building recurring revenue streams and fiercely protecting its intellectual property. If that was not enough, this hidden champion apparently has a tidy amount of net cash, representing around 35% of the company's total market capitalization. Let us pause on that for a moment. Having so much currency on hand can make or break a business in challenging times. If a company has financial fortitude, it can weather unexpected storms, strategically invest in research and development, or even snap up attractive assets at knockdown prices. This fortress-like balance sheet could be the reason Celebrus remains so buoyant in terms of profit. And if the analysts' chatter of around 14 pence per share in forward earnings is accurate, the stock might be trading at roughly 10 times forward earnings. By broader tech standards, that can be considered extremely reasonable, especially since it mails out a dividend yield of around 2.1%, which is not common among small or mid-cap technology outfits. Imagine collecting dividends while also potentially enjoying share price appreciation. The catch, of course, is that small-cap tech can sometimes feel like a roller coaster made out of matchsticks, exhilarating in the good times, nerve-wracking when the wind shifts. Celebrus may announce a dismal quarter that sends some investors scrambling. Then again, the company could ride a wave of digital transformation that lifts it to new heights. In the volatile realm of technology, timing and strategic vision often define who thrives and who stumbles. So, can Celebrus keep delivering on expectations, building momentum until it finally calls the scoreboard in its favor? Now, let us take a step back and look at the broader market environment. The FTSE 100 is up roughly 7% since the start of the year, a performance that many would call modestly strong for an index so closely tied to a range of diverse sectors. We have come a long way from the darkest days of global crisis. As industries like travel, defense, aerospace, and technology recalibrate to the new normal, it has become evident that plenty of British stocks still fly under the radar. Are you excited by these glimmers of possibility? Is your pulse racing at the thought of discovering the next big mover in the United Kingdom's complicated but promising market environment? If so, now might be the perfect moment to show a little love for the content. Go ahead, give us a thumbs up or a like if you feel the rush of exploring these hidden prospects. That said, one must always proceed with a measure of caution. Just because a stock looks cheap does not guarantee an easy path to riches. Market forces can be fickle, and businesses must navigate everything from regulatory upheaval to unforeseen competitor innovations. As we continue through this script, you will hear about encouragements and red flags alike. Let us maintain the balance of optimism and practicality, ensuring that each potential gem is measured by more than a single or superficial metric. Speaking of optimism, one major theme still pulsing in the background is the ongoing resurrection of civil aviation. People are traveling again, airports are bustling, and airlines are adding new routes to reconnect families, businesses, and explorers. Defense budgets have also ballooned in some parts of the world, spurred on by global tensions and the desire to modernize fleets and equipment. This kind of environment fuels demand for advanced engineering solutions, specialized parts, and collaborative research, which can confer huge benefits to well-positioned companies. We only have to look at the dizzying share price leaps of some aerospace titans to sense that the market is brimming with high expectations for the future. Yet, in the midst of all that excitement, we encounter areas of the sector that remain strangely overlooked. Melrose Industries represents precisely that paradox, overshadowed by the Rolls-Royce fireworks, yet quietly loading up on big plans. The question is whether enough battle-weary investors will take a second look before the rest of the market wakes up. Timing, after all, is crucial. So, why do the experts remain confident, or at least hopeful, about Melrose? It is not just the aforementioned growth targets or the ability to command unique market niches. A major part of the puzzle lies in an often overlooked truth. Building a single commercial engine or advanced component is not child's play. It requires extensive research, carefully guarded patents, and, frequently, a strong track record of proven delivery. Companies that do manage to check those boxes can secure decades-long supply agreements, ensuring consistent revenues over time. But is there a direct connection between supply chain bottlenecks and Melrose's future success? Absolutely. If shipping times start to normalize and raw materials become more readily available, that 20% annual earnings growth might accelerate faster than expected. Alternatively, if these disruptions worsen or new crises pop up, hitting the entire supply network, we might see the company's lofty ambitions deflated like a forgotten balloon. Hence, the next few quarters will be pivotal. Meanwhile, Celebrus Technologies stands at the intersection of data, software, and specialized services, each of which has become indispensable in our hyper-connected world. As consumer preferences evolve at warp speed, businesses thirst for solutions that interpret and anticipate user behavior. Celebrus, with its evolving product suite, particularly around highly scalable software innovations, appears well poised to capture that demand. It is intriguing to note how the evolving technology landscape offers staggering opportunities for companies that can stand out from the crowd. Celebrus has made no secret of its pursuit of dependable, recurring revenue streams, presumably from long-term contracts that offer steady cash flow. This is no small endeavor. Many small technology firms chase project-based income, which is notoriously lumpy, leaving them vulnerable to even the mildest economic downturns. By contrast, if Celebrus can secure these recurring deals, it may insulate itself from destructive revenue swings. Moreover, the potential to expand globally cannot be overlooked. While the United Kingdom is a fantastic market, Celebrus might well cast an eye to continental Europe, North America, and beyond. The more markets it can capture, the stronger its brand becomes, which in turn can bolster profitability. And let us not forget that significant net cash position, which could be utilized for strategic acquisitions, further research, or simply as a cushion to ride out tough cycles. Still, we must weigh the risk of a single shocking announcement that can send small-cap investors into panic mode. If Celebrus were to miss its revenue targets or suffer an internal crisis, it could prompt the market to punish the stock severely. This is precisely why clarity in corporate strategy and communication is key. Investors will be watching closely to see if management can maintain a steady hand on the wheel. At this juncture, imagine yourself in a conversation with someone new to both of these stories. They might well ask, if Melrose is so strong, why are they trailing Rolls-Royce by such a huge margin? If Celebrus is so promising, why have we not seen more coverage in leading financial publications? The answer to both questions may revolve around timing, perspective, and the highly selective way certain success narratives dominate the media. Rolls-Royce's near tenfold leap is a sensational story that naturally grabs headlines. Some smaller companies or those overshadowed in their sector simply do not command the same immediate buzz. Yet that does not diminish their potential. On the contrary, it might offer an advantage for on-the-hunt investors who prefer to get in before the spotlight becomes too bright. Remember, it was not so long ago that many overlooked Rolls-Royce, regarding it as old-fashioned or weighed down by structural issues. How quickly times can change, particularly when an industry is pivoting toward a brand new era. In the next few minutes, we will delve into even more insights, connecting the scattered dots and painting a fuller picture of these companies. We will explore Melrose's moat-like status in greater depth, examine Celebrus's capacity for innovation, and circle back to the constantly shifting macro environment that influences every piece of the puzzle. So, do not go anywhere. Because if you are as fascinated as I am by where these tickers might be heading, you will want to hear the deeper story behind the illusions and the realities. And hey, if you find yourself enthralled by these revelations, if your curiosity is piqued by the underdogs of the corporate world, consider subscribing to our updates. That way, you will be the first to know when deeper dives and fresh insights into hidden opportunities land on your screen. Let us address a critical question. How does an aerospace and defense firm like Melrose even begin to craft a 5-year plan that includes boosting revenue by 43% and doubling margins? Often this starts by focusing on the fundamentals, pruning underperforming segments, enhancing manufacturing processes, renegotiating supplier contracts, or investing in automation that reduces overhead costs. While that might sound like a typical corporate to-do list, the difference lies in the magnitude of improvement they seek. Over the past couple of years, many manufacturers have tried to cope with supply chain disruptions by reshoring certain production lines or forging more robust partnerships closer to home. This shift can be hugely beneficial, but it requires capital, planning, and the right leadership. Melrose, known for its strategy of acquiring engineering-oriented businesses and turning them around, might be leveraging this momentum to reimagine its entire operation for a post-crisis world. If they succeed, the payoff could be enormous. Pivoting back to Celebrus Technologies, we have touched on its software potential, but let us dig deeper. One reason technology firms chase subscription or software as a service models is the consistent revenue it brings. Once you have integrated a solution into a client's workflow, the switching costs for that client can be considerable. Celebrus, according to watchers, might be refining software that deals with data analytics, user interactions, or even advanced marketing solutions, areas that many businesses treat as mission critical. If Celebrus can keep those clients hooked year after year while also building brand loyalty, the runway for growth is impressive. Small-cap companies sometimes remain small because they fail to offer must-have services that lock in customers. Conversely, if they do, they explode onto the scene with the unstoppable momentum every investor dreams of. That is why hearing about Celebrus's fortress balance sheet is so captivating. It potentially arms the company with the resources to lock in top talent, branch into new verticals, and keep forging ahead even if the macro climate gets choppy. While we champion these possibilities, it is critical to keep measurement tools at the ready. Valuations, after all, need to reflect the actual prospects for growth. Too often, the market can inflate a stock's price based on hype alone. Other times, it can undervalue a company that is quietly executing on all cylinders. Melrose's PEG ratio of around 0.7 hints that it might be in the latter camp. The market has not fully factored in the potential of that 20% annual earnings growth. Likewise, if Celebrus's forward price-to-earnings ratio truly hovers in the range of 10, that could be a glaring mispricing, especially for a tech name with global ambitions. But keep your eyes firmly on the horizon. One disappointing press release from Celebrus or a series of missed production targets for Melrose could shift sentiment in a heartbeat. Investing, particularly in these under-the-radar picks, involves risk. That is why many market veterans speak of diversification, hedging, or setting stop-loss levels. Nevertheless, for those who relish the thrill of seeking out the next star before it becomes a supernova, such opportunities remain eternally tempting. So, where do we go from here? Typically, seasoned analysts would check the financial statements of these companies, compare their performance track record, see if debt is at manageable levels, and then gauge how likely it is for them to deliver on stated promises. Melrose's debt might unnerve some watchers, but if earnings explode as projected, that burden diminishes relatively quickly. Meanwhile, Celebrus's emphasis on cost controls and pivot into higher-margin software solutions could be the catalyst that keeps those earnings robust, despite modest top-line growth. For industry watchers, the next few months could be particularly revealing. The aerospace world is not just about engines. It is about integrated avionics, advanced composite materials, and cutting-edge research that reads like something out of science fiction. Melrose's ability to navigate that labyrinth, forging alliances and continuing to hone specialized solutions, could propel it toward that ambitious margin-doubling goal. If that margin expansion becomes apparent in earnings reports, sentiment may shift quickly. With Celebrus, watch for announcements about client wins or expansions into new verticals. Does the software solve problems quickly? Is the user interface intuitive and robust enough to lock in clients? Will they continue to maintain that meaty net cash position, or will they redeploy funds for acquisitions that further bolster revenue potential? Each of these developments can offer clues about the stock's trajectory. Stepping back to the bigger picture, some voices in the market are speculating that the second half of this year could be marked by more stable supply chains, cautious but real improvements in consumer sentiment, and increased corporate spending. particularly in technology. If that forecast holds, it may ignite the fuse that both Melrose and Celebrus need. On the other hand, global events can pivot on a dime, turning bright skies stormy and leaving even the most carefully drawn forecasts in tatters. And that is precisely why, for many of us, the stock market is so riveting. It is equal parts chess game and exploration of human behavior, a place where excitement and anxiety mingle in constant tension. Melrose stands tall with engineering brilliance and a plan, yet depends on the smooth function of a global supply chain that often operates beyond any single company's control. Celebrus dazzles with a stable balance sheet and cunning software strategy, but the rotating kaleidoscope of macroeconomics could either supercharge or suffocate its next moves. Yet among these swirling possibilities, we are left with an undeniably captivating premise. Two British stocks that could quite realistically outpace the broader index in the near future, provided certain conditions align. Whether they become the next headline-grabbing success stories or slip into the background is a narrative still in the making, and one that you, the savvy observer, have a front-row seat to witness. For those of you itching to know the final word, there is no absolute guarantee in the market. Still, the research suggests that Melrose Industries and Celebrus Technologies hold the keys to unique corners of the economy, from essential aerospace components to data-driven intelligence solutions. Factor in the potential undervaluation suggested by their current earnings multiples. Combine it with the powerful catalysts of returning flight traffic and an unquenchable thirst for digital transformation, and you have the makings of a very compelling storyline. As we wrap up, we hope this deep dive has sparked new thoughts, fueled your desire to look deeper into the underexplored realms of industrial engineering and software innovation, and perhaps even stirred a sense that big opportunities might be hiding right around the bend. In the world of stocks, the distance between overlooked and overbought can be traveled at shocking speeds. Will Melrose surpass its peers in the aerospace domain? Will Celebrus become a quiet giant in the realm of digital technologies? We can only watch, analyze, and stay open to what might come next. That is all for today's exploration of these captivating United Kingdom stocks. If you found a nugget of wisdom or a spark of excitement along the way, consider sharing this discussion with someone else who might be curious about the less obvious corners of the market. Thank you for joining us on this journey, and may your own explorations continue to uncover the next hidden gem.